What is up, you guys? Thanks so much for joining me today. It's your boy, the Finance Bro, and in this video, we're going to be taking a look at shares of the capital market operator of the Nasdaq Stock Exchange, Nasdaq Incorporated. See where shares are trading today, and if this is a good entry point for investors long term. As always, this video is not investment or financial advice and is solely for entertainment purposes. All values that you'll see within this video are as of market close on May 13th, 2026. So let's dive right in here to the past 12-month performance of shares of Nasdaq Incorporated. As you can see there, on a one-year basis, shares underperformed the benchmark by almost 14%. The benchmark produced a 25.4% return, comparing that to the 11.5% return of Nasdaq Incorporated shares over a one-year basis. Also, on a year-to-date and one-month basis, shares are underperforming the benchmark, but on a one-week basis, they have outperformed. I do just want to mention that the financial sector as a whole has taken a hit at the start of 2026 for a variety of reasons, whether it would be private credit issues, loan issues, and so forth. But Nasdaq Incorporated, the nature of the business that they're in, it's kind of insulated from those negative headwinds, which is why Nasdaq Incorporated shares, comparing that to the financial sector as a whole, have actually outperformed that sector. In that graph there, you can see the 12-month performance of shares as well. Shares are around 10% below their 52-week high, yet shares are still trading above their 50 and 200-day moving averages. But that green line there, which is the 50-day moving average, in late February, early March, did dip below that 200-day moving average, which is that orange line, which does indicate a technical sell signal. But with the positive momentum through mid to late March into where we are right now, this has made that spread between the 50 and 200-day moving average compress. And hopefully, if this positive momentum lasts in Nasdaq Incorporated shares, we should see that 50-day moving average in the not so distant future cross over the 200-day moving average to indicate a technical buy signal. A few key items here. I want to just point to the earnings per share. Solid earnings per share over the past few years, and an explosion from 25 through 27. And that's just because of the long list of IPO lineups that NASDAQ has had. And especially over the past few years, you see that EPS growth just due to the fact a lot more companies want to list an IPO on the NASDAQ exchange. And if we're looking at the number of companies in the sector, mainly that is IPOing, is a lot of technology companies, which historically the NASDAQ has brought to market and managed to host a lot of the big tech names on its exchange. You can see on the dividend side a 1.4% yield. We'll touch on that later on in the video, as management has significantly increased shares dividends over the past actually 4 years. Sales are pretty steady at 6%. This is not a company that is going to have explosive growth based on its previous operations, but in a later snippet, we will touch on the projected growth, which should essentially boost these sales numbers, and as well, the acquisitions and the businesses that they're gravitating towards in their different segments are higher margin businesses. So when we look at that gross margin at almost 60%, net margin of 23.1%, EBITDA margins of 38.4%, we should continue to see those margins expand. They are operating in data management, cloud services. Also, AI is making their margins a lot more, hopefully, expanded with the operational efficiencies that management is trying to execute on. And when we look at shares on a valuation metrics, look at that forward PE of 22.1. That is not an overvaluation by any means. And that price to sales ratio at 6.3 is nothing to worry about as well. And you can see on those trends, and we'll touch on later on in this video, fairly in line with both their 5 and 10-year averages. When we look at the price target, there are 18 analysts who cover NASDAQ Incorporated shares. On average, they have a $111.31 price target, which does imply a 22.41% upside from where shares traded on May 13th, 2026, with the most pessimistic analyst having a $96 share price, which does imply an almost 6% upside, with the most bullish analyst at $128 a share, which does imply an almost 41% upside. You can see in that bar graph there, the red bar is essentially nil. There are no sells on the name right now, and there hasn't been a widening of share prices in that hard blue line relative to analyst target prices in that dotted line there, which shares should catch up to their true valuation. And having that institutional money backing that and knowing that it is undervalued should help boost shares over the next 6 to 12 months. Like I mentioned before, when we look at these 5-year trends, nothing that screams an overvaluation. In fact, possibly an undervaluation. When you see here on that forward PE of currently at 22.1 on its 5-year average of 22.5, it is undervalued on that valuation metric alone based on its 5-year trend. Price to sales as well at a 5.4 average. We're not even 1 point higher at 6.3 currently. With the growth of the underlying business that we'll see in its projections later on in the video, this could be a good entry point based on the valuation of where shares are trading today. But when we look at it relative to the peer group, now, these are very different businesses. Nasdaq and Intercontinental Exchange operate fairly similar models. The Miami International Holdings is a little bit different. That has seen a big pop over the past, really since COVID, with a lot of the flocking of big financial companies to the Miami core as a whole. The CBO Global Markets does operate in a more highly efficient and high margin business. With the derivatives business, MSCI is able to have larger margins, and we'll see this in the next snippet here, but they're able to have larger margins just because they are a more international operator, which essentially means they're able to employ employees in certain regions where the cost of labor is lower. And the London Stock Exchange Group itself does operate the London Stock Exchange, which is heavily saturated in precious metals and energy. Why that's important is really in the next snippet there. But when we look at valuation metrics, we should value these differently. But essentially, Nasdaq and ICE as well are the same business, with Nasdaq obviously catering to a more technological consumer base, obviously hosting a lot of big tech names on its exchange. Ironically, the Intercontinental Exchange, just based on these valuation metrics, is indicating a cheaper value and a better multiple than Nasdaq. But I do believe with the projections of where the company is going, Nasdaq Incorporated does offer a better value for investors long term. And when we look at the operational businesses, the underlying fundamentals of these businesses, you can see with those gross margins, what I was talking about, why it's so different for, say, Nasdaq Incorporated to MSCI. Nasdaq has that 55.9% gross margin, but when we look at the MSCI index, which is the global operator of a lot of indices in both developed and developing regions, and in those developing regions, you're able to have a cheaper cost of labor, which is why they have higher gross margins relative to the group as a whole. But when we look at that return on equity and assets, Nasdaq Incorporated is one of the highest. The CBOE is actually higher just because of the nature of business of their derivatives and options underwriting, which essentially means that they're able to have a high return just through the leverage of the business that they operate in. But when we compare Nasdaq Incorporated to Intercontinental Exchange, that 15.3% return on equity relative to ICE's 11.7 does indicate a more operationally efficient business of Nasdaq itself. And we can see those trends essentially very steady. We did have gross margins decline relative to its average not too far after COVID, and that was a lot of the SPAC craze, and that did lead to a bubble popping where you didn't have as much IPOs coming to market, which did hurt the bottom line of Nasdaq itself. But we are seeing that trend obviously has recovered and then some over the past few years. And more importantly, that return on assets, equity, total capital, and invested capital is still healthy, yet the share repurchases that they've done, and I'll touch on in a later segment, they bought shares back at the highest rate in this company's history, and with shares underperforming, that has created a drag. 11% share price return over the past 12 months relative to the return on equity of 15.3, that return on equity could be higher if shares didn't drag those metrics down. But when we look at the financial statement, sales revenues growing at an 8% 5-year and a 9.3% 10-year compounded annual growth rate. You're looking at healthy CAGRs here, essentially in net income, 13, almost 14% on a 5-year and 15.4% on a 10-year compounded annual growth rate, and earnings per share continuing to trend in the right direction, 10.6% on a 5-year and 14% on a 10-year CAGR. And those were historical numbers. We saw those projections, and we should see even larger earnings per share growth in coming quarters and essentially through 2027. And this is what I was talking about here. These bar graphs essentially discuss a few different stories here. That yellow, debt servicing, they are paying down debt handsomely, which is like what we want to see. But that dividend increase, you can see, is at its highest amount over the past 5 years and in its company's history. But what's really telling here is that share repurchase, phenomenal to see there. Over that course of time, shareholders are getting not only dividend increases, but artificial, fictitious dividend increases through share buybacks. And the company is seeing their shares really undervalued to what the market is pricing it in. So long term, this should add value to the company's bottom line and its financial statement. Lastly, here, I just want to touch on the different segments. You can see that being an exchange operator isn't the only segment that Nasdaq Incorporated operates in. What's really important here is that financial crime management technology increasing, the index services as well increasing, data and listing services, licensing services. These are very high margin businesses that offer reoccurring revenue to Nasdaq Incorporated as a whole, and these are experiencing high growths year over year. And we're seeing those trends. You can see in all those bar charts there, healthy trends in the coming quarters, which should continue to, that's what I was touching on before, expand margins for the company as a whole. They already operate in a very high margin business, but offering these other services and also cloud services should continue to improve operational efficiency, which should transpire to better revenues, margins, and shareholder returns over the long term. So here I just want to touch on a few positives for NASDAQ as a whole. These were a few points that I alluded to earlier on in the video, but we are starting to see stronger technical buy signals. We are seeing that 50-day moving average and 200-day moving average gap close and is projected, hopefully in the coming weeks, to cross over and indicate a positive buy signal. And with the relative strength index hovering around 61, this does indicate positive momentum is still projected for NASDAQ shares without having to worry about surpassing that 70 or 80 number in relative strength index, which does indicate an overbought name. So there is still room to grow. And we're also starting to see a lot of positive institutional interest like we saw in those analyst target prices. There is a discrepancy to where shares are trading currently to where institutions believe the true value of Nasdaq Incorporated truly is. And they are diversifying their revenue like we saw in those multiple different segments and diversifying into high revenue and high margin segments. Their market services, for example, revenue in this sector alone recently saw a 14% year over year increase in its most recent quarter, which was fueled by strong performance in derivatives and cash franchises. So starting to take away little pieces here and there from the CBOE business model. And the financial crime management unit, which is a very high margin segment, including anti-money laundering and fraud detection technology, has grown in its most recent quarter 25%, showcasing the company's ability to scale software as a service offerings to customers. I know SaaS recently, in the past, I would say 6 to 8 months, is no longer the same as it used to be with the AI threat, but Nasdaq Incorporated is staying ahead of the game through strategic acquisitions and AI integration in its operations, cross-selling of a few of its different acquisitions of Xiom SL and Adenza is allowing the Nasdaq platforms to deepen its relationship with banking and institutional clients by offering regulatory and risk management software. Which was very intriguing to me is the cloud and AI segment has grown significantly and is actively having AI integrated to enhance data sales and trade surveillance, positioning the company as a leader in modernized market infrastructure. All the companies in the peer group are investing into AI to have more efficient operations and regulatory requirements to operate. But NASDAQ Incorporated as a whole has been very aggressive in ensuring that they are staying ahead of the game just due to the types of companies that NASDAQ Incorporated essentially caters to there. And we're seeing an improving capital market environment as a whole, which is helping that earnings per share projection increase. It's having a very healthy IPO pipeline. We're seeing a lot of well-known names coming to market in 2026 and 2027. And these are essentially big ticket IPOs, some of the largest we'll see in history to date. And the power of the NASDAQ 100 and being the operator continues to benefit from having massive inflows into the tech heavy ETFs and tech as a whole driving markets, not just for the past 10 years, but you look at it through 2026, it has been the best performer. NASDAQ is still continuing to draw the best in class technology companies to IPO and host their stocks on the NASDAQ exchange, making it the premier destination for these companies. As a whole, this is why I personally believe NASDAQ Incorporated is an undervalued company right now and offers a good buying opportunity relative to its peer group. As always, this is not investment or financial advice. It's solely for entertainment purposes. Just want to present to you guys a few facts and snippets in this video. Please hit that like and subscribe button. It means a lot to me. And stay tuned for the next video.